Today, we're going to uncover the exact rules Warren Buffett used to become one of the richest people in the world. We'll break down the habits, choices, and strategies that allowed him to build billions from nothing. If you follow these lessons carefully, they can change how you think about money forever. Imagine missing out on life-changing wealth. Not because you lack talent or luck, but because you never understood the rules that create billionaires. Buffett didn't stumble into success. He built it step by step, with methodical rules guiding every move. Every decision he made had intention and insight behind it. Most people chase the wrong things. They chase trends, hype, or the latest, get-rich-quick, schemes. Almost none of these paths work long-term. Buffett's approach is different. It's not about luck or being first. It's about understanding value, human behavior, and patience. Rule 1: spend less than you earn. It sounds obvious, but most people fail here. Buffett saved from his very first jobs delivering newspapers and selling gum. Saving early creates leverage. Money saved is money that can grow through investments. Even small amounts, over time, multiply into real wealth. Psychologists call this self-control and delayed gratification. Humans naturally prefer instant rewards. Those who resist short-term impulses gain massive long-term advantages. Every small unnecessary purchase adds up. A daily coffee, impulse online shopping, unnecessary subscriptions, they compound. Buffett avoided this from a young age. Rule 2: invest only in what you understand. Buffett avoids businesses he can't explain simply. He sticks to companies whose operations and value he fully comprehends. This reduces risk. Complex investments often hide traps and unseen vulnerabilities. Understanding gives clarity and confidence. Behavioral economics shows most people overestimate their knowledge. They follow hype, fear, or trending advice. Buffett stays rational and calm under pressure. Rule 3: think long-term. His favorite holding period is famously, forever. Short-term market swings do not dictate his decisions. Most investors panic during market drops. They sell in fear and miss growth opportunities. Buffett buys quality and holds it patiently. Long-term thinking leverages compound interest. Even modest investments grow enormously over decades. Patience multiplies wealth far beyond any short-term gamble. Rule 4: focus on quality, not quantity. Buffett doesn't diversify blindly. He invests in a few strong companies he trusts. Over-diversification reduces returns. Holding too many mediocre assets dilutes overall performance. Concentrated investments in quality yield more significant gains. Rule 5: avoid debt whenever possible. Buffett warns against using leverage recklessly. Debt can amplify losses faster than it amplifies gains. Credit cards, loans, and risky leverage trap most people. Buffett stays liquid and avoids high-interest obligations. This gives him flexibility and peace of mind. Rule 6: think independently. Buffett rarely follows the crowd. He makes decisions based on research and logic, not popularity. Herd behavior in markets causes people to buy high and sell low. Buffett waits, evaluates, and acts based on facts. This independence creates opportunities others miss. Rule 7: prioritize learning continuously. Buffett spends hours reading every day. He treats knowledge as compoundable wealth. Investing, business, and human behavior all evolve constantly. By learning consistently, Buffett stays ahead of trends. Knowledge allows better judgment and fewer mistakes. Early in life, he read every investment book he could find. He studied businesses, market patterns, and human psychology. This built the foundation for decades of profitable decisions. Buffett's rules aren't magic. They are simple principles applied consistently over time. Simplicity plus discipline equals extraordinary results. Most people underestimate consistency. They think wealth comes from luck or genius. In reality, it comes from applying the basics better than anyone else. Spending less than you earn. Investing in what you understand. Thinking long-term. Focusing on quality. Avoiding debt. Thinking independently. Prioritizing learning. These 7 rules form a system, not isolated tips. Imagine applying even a few of these in your life. Small changes in behavior now compound into freedom and security later. This is how Buffett turned modest savings into billions. Behavioral science explains why this works. Humans are naturally impatient, risk-averse in some ways, and influenced by social pressure. Buffett designs his life and choices to counter these tendencies. For example, the average person spends impulsively. They follow trends in stocks, crypto, or consumer goods. Buffett avoids this because he understands the hidden costs of emotion-driven choices. Another hidden pattern is fear of missing out. Most people buy assets because everyone else is buying. Buffett buys when others are fearful and sells when others are greedy. This flips the psychological trap most people fall into. It's easier said than done, but the principle is clear: act based on analysis, not emotion. Consistency beats intensity. Patience beats impatience. Knowledge beats speculation. Buffett also understands opportunity cost. Every dollar spent unwisely is a dollar that cannot grow. Every hour wasted is lost potential for learning or investing. Even seemingly small decisions compound over decades. Skipping that fancy gadget, delaying a purchase, reading a book instead of scrolling social media. These micro decisions accumulate massive advantages. Buffett's wealth isn't from flashy investments. It's from disciplined habits repeated over decades. Behavioral control, not luck, drives the outcome. Markets are unpredictable. Short-term volatility scares most people. Buffett treats volatility as an opportunity, not a threat. He also avoids trying to time the market. Most people buy high, panic sell low, and underperform. Buffett's long-term perspective eliminates these costly mistakes. Psychologists call this the sunk cost fallacy. People stick to bad decisions because they've already invested time or money. Buffett cuts losses and focuses on value, not ego. He invests with a margin of safety. This means buying below intrinsic value. This simple rule protects against mistakes and market unpredictability. Buffett studies industries, leadership, and company culture. He doesn't chase speculation. He buys businesses, not stock tickers. He values trust in management. Without reliable leadership, even profitable companies fail. Human behavior drives business success, not spreadsheets alone. Buffett also embraces simplicity in investments. He avoids complicated financial instruments. He sticks to businesses with clear earnings, assets, and potential. Complexity often hides risk. Most people overestimate their understanding of intricate investments. Buffett keeps it simple to avoid hidden pitfalls. Buffett also understands the power of compounding beyond money. Time invested in learning, relationships, and decision-making compounds just like money. The earlier you start, the more exponential the results. Most people underestimate small consistent actions. They think huge leaps or lucky breaks are required. In reality, daily habits make the difference over decades. Buffett surrounds himself with smart, disciplined people. He knows environment shapes decisions. Your network influences behavior, spending, and thinking. Behavioral science confirms this. Humans are highly influenced by peers. Choosing the right people to learn from accelerates growth. He also avoids lifestyle inflation. When income rises, many people spend more, negating gains. Buffett keeps living modestly, even as wealth grows. This builds freedom. Lower expenses reduce pressure to take riskier unwanted jobs. It gives control over choices and time. Buffett's morning routine includes reading and thinking. He dedicates hours to absorbing information daily. Knowledge compounds just like money over time. Learning allows smarter decisions. It reduces mistakes caused by ignorance. It's the invisible engine behind his wealth. Buffett also embraces patience in opportunity. He waits years for the right investment. Impulse and hurry rarely yield the best outcomes. Psychology shows humans fear missing out. This drives bad decisions and overpaying for assets. Buffett flips this, acting calmly and rationally. He measures success by long-term outcomes. Short-term praise, status, or profit doesn't guide him. Behavior and discipline define results, not emotion. Buffett invests in businesses, not stocks. He looks at cash flow, product demand, and leadership quality. The underlying business is more important than market sentiment. This principle is widely ignored. Many chase ticker symbols or hype. Buffett focuses on real-world fundamentals. He also evaluates management carefully. Competent, honest, and skilled leaders multiply the value of investments. A business is only as good as the people running it. Most investors overlook this. They rely solely on numbers. But psychology, integrity, and competence drive performance. Buffett uses a margin of safety in every decision. He buys below intrinsic value. This reduces risk and ensures potential reward exceeds possible loss. Most people overpay out of fear of missing out. Buffett waits for opportunities that protect against mistakes. Discipline beats speed in the long run. He avoids leverage except when absolutely certain. Debt magnifies both gains and losses. Buffett prefers flexibility over potential short-term profits. This reduces stress. It allows rational, clear-headed decisions under pressure. Most people fail because emotional decisions and debt compound mistakes. Buffett also avoids trends and speculation. He doesn't chase cryptocurrencies, memes, or viral tech hype. He sticks to businesses that make sense. Behavioral economics explains this. Humans are drawn to novelty and social proof. Buffett counters this with rational analysis and patience. He also prioritizes consistency. Not every investment is a hit. But repeated application of principles ensures long-term success. Consistency outweighs intensity. Short bursts of brilliance are fleeting. Discipline, repeated daily, compounds wealth and knowledge. Buffett also understands the value of reputation. Integrity in business attracts better deals and partnerships. Trust is an undervalued asset in every market. Most people ignore this. They seek short-term gain even at the cost of credibility. Buffett knows credibility compounds opportunities over decades. He reads extensively, financial reports, newspapers, and books. This informs every decision and expands perspective. He treats learning as an investment, not a chore. Knowledge allows anticipation of trends. It reduces mistakes born from ignorance. It compounds quietly in the background of daily life. Buffett also focuses on understanding the psychology of others. Market behavior is driven by human emotion, fear and greed. By observing patterns, he acts when others panic or overreact. Most investors follow crowds. They buy high, sell low, and lose money. Buffett profits from calm analysis in contrast to mass emotion. He also values patience over speed. Quick decisions without analysis often fail. Buffett waits for the right setup, no matter how long it takes. Time is an ally in both investing and personal growth. Decisions made today affect decades of outcomes. Small choices compound into life-changing results. Buffett's daily routine emphasizes simplicity. Avoiding distractions frees mental energy for high-value thinking. Clarity of thought is an invisible advantage over the majority. Most people are constantly distracted. They chase notifications, trends, or low-value tasks. Buffett protects his focus like a high-return asset. He also sees the value of reading human behavior. Psychology explains why markets move irrationally. Understanding this allows him to exploit patterns while avoiding mistakes. People are predictably irrational. They overreact to news, fear losses, and follow social cues blindly. Buffett structures decisions to capitalize on this predictability. He also invests in businesses with strong moats. Competitive advantage protects earnings and reduces risk. Brands, patents, and efficiency create defensible positions. Many companies appear profitable short-term. Without a moat, competition erodes value over time. Buffett focuses on enduring businesses, not fads. He also embraces transparency. Clear, honest reporting allows him to make informed choices. Opaque businesses are avoided. This reduces unseen risks. It forces management to act with discipline. It aligns incentives with shareholders over ego. Buffett also leverages tax efficiency. Understanding tax rules multiplies returns legally. Compound growth after taxes is much stronger than before tax growth. Most investors ignore taxes. They overtrade or mismanage strategies. Buffett plans ahead to maximize long-term compounding. He also stays humble despite massive wealth. Humility allows better learning, relationships, and decisions. Arrogance leads to mistakes and overconfidence. Most people overestimate their abilities. This leads to bad decisions, high risk, and losses. Buffett's humility tempers his actions with reality. Buffett's life illustrates a key insight. Wealth is built by consistent, rational, and disciplined choices over decades. It is not about luck, speed, or hype. Small actions repeated daily compound into extraordinary results. Spending wisely, learning constantly, and thinking independently shapes the outcome. Patience, focus, and understanding human behavior amplify every decision. Applying even a few of these principles transforms perspective. The average person can improve financial and personal outcomes dramatically. Buffett proves simplicity plus discipline beats complexity and impulsivity. Real power comes from mastering your behavior, not chasing trends. Behavior drives money, not the other way around. Psychology underpins every financial decision. Every purchase, investment, or choice has a hidden cost or opportunity. Buffett analyzes these costs carefully before acting. Most people act emotionally, ignoring unseen consequences. Compounding works in life, not just money. Learning, patience, and relationships grow exponentially. Buffett treats each as an asset to be nurtured daily. By following these 7 rules, anyone can build freedom and opportunity. The principles are simple, but execution requires discipline. Consistency over time is the true multiplier. In the end, Buffett's success isn't flashy or mysterious. It's predictable when you understand the psychology, behavior, and strategy behind it. Ordinary actions done extraordinarily well create extraordinary outcomes. The same patterns can apply to your finances, decisions, and long-term planning. Discipline, patience, knowledge, and rational thinking compound quietly, invisibly. Over time, they surpass luck, hype, and chance. Buffett shows that wealth isn't about chasing the next big thing. It's about controlling what you can, your choices, your learning, and your behavior. Master those, and the rest follows.